This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making from two Canadians. We are hosted by me, Benjamin Felix, Chief Investment Officer, and Cameron Passmore, Chief Executive Officer at PWL Capital.
Welcome to episode 384. And Ben, I was taking down notes during this conversation, which was an incredible conversation. It's kind of like, I think I called it the great trilogy of listeners, right? It might be even more than three factors going on here, but to talk about factors, global diversification, private investments from a great, super nerdy, super technical academic who is a great communicator. It's like, this is the happy place, I think, for so many of our listeners. This was a phenomenal conversation.
Yeah. Nice to do a nerdy episode. It feels like it's been a while.
It's been a while, and it was because it talked about questions that we get all the time and our team gets all the time from clients, especially when we got into the part at the back end around private investments and the research that he's done. So our guest this week is Mamdouh Medhat, who is a researcher, investment manager, and VP and senior researcher at Dimensional Fund Advisors in London. People know that we do a lot of work with Dimensional here. So with that, Ben, why don't you kind of tell a background story and
the background story is that Mamdouh wrote a very interesting paper with Robert Novy-Marx, who of course we've had on this podcast, about profitability. So they wrote what they called a profitability retrospective. So Professor Novy-Marx wrote his paper on profitability, I believe, in 2013. And it had, as Mamdouh talks about during the podcast, it had a huge impact on academia. It was added to the Fama and French five-factor model, which was like, that's a huge thing. That's the main workhorse model in academic finance, like the benchmark model. And it influenced Dimensional's investment strategies. They incorporated profitability into their portfolios, the way that they sort and weight stocks. And so have other asset managers all around the world. And so they wrote this paper looking back since that original paper was published. What have we learned about profitability since its initial publication? And so they look at a whole bunch of interesting questions. They look at quality metrics. They look at defensive or low beta stocks. They look at the performance of value, and they ask how profitability relates to all of those things. So we talked about that in the first part of the episode. But then, of course, so that was co-authored with Mamdouh and Robert Novy-Marx. Mamdouh has other awesome research. So we also asked him about that. We talked about industry and country tilts, like whether it makes sense to tilt toward or away from a country based on its aggregate characteristics. That was an interesting discussion. And then we also talked about, he has a really interesting paper looking at private market fund performance. He looked at private equity, credit, and real estate, and did really deep analysis on the returns of each asset class, but also looked at its public market factor exposures. So like when you invest in buyouts, what public market factor exposures are you actually getting by doing that? We've talked about private markets for quite a while at the back end of the episode, but really interesting conversation. So profitability, like for I don't know, for the average index fund investor, maybe the profitability discussion is not as exciting. For anyone that's tilting toward factors, it's really important. Profitability is incorporated into a ton of factor models. It's incorporated into a ton of investment products. So how to think about it, how to measure it, does really matter. Anyway, so hopefully that's that part of the discussion is interesting for everyone.
For sure. So as I said, he's currently the VP and senior researcher at Dimensional Fund Advisors, has a PhD in financial economics from Copenhagen Business School. Pretty cool.
Very cool. Yeah. So he was previously an academic doing academic research. He's now arrived at Dimensional, still doing academic research, but also doing more practitioner-oriented research. Obviously, being at Dimensional, so research that they're using, research that they're publishing for their clients and other people to use. That would be like the private markets paper is
Yeah,
that they get a lot of questions about private markets. Should Dimensional be in that space? Should I, Dimensional's client, be in that space? So that's why they would do that type of research. Anyway,
exactly.
we covered lots of ground. Super interesting conversation. And like you said earlier, Cameron Mamdouh is a great communicator.
Okay, with that, let's go to our conversation with Mamdouh Medhat.
Mamdouh Medhat, welcome to the Irrational Reminder podcast.
Thank you very much. Happy to be here.
Very excited to be talking to you.
Indeed.
Yeah. All right. So to kick it off with the first question, can you talk about why it was important for you and Professor Novy-Marx to write a retrospective paper on the profitability premium?
Sure. So I think it's pretty, it's really without a doubt that Robert's 2013 paper had quite a bit of impact on the academic literature. For instance, Gene Fama and Ken French added a profitability factor to their 5-factor model. That's a pretty big deal. And we also have, billions of dollars now in quality funds, and they don't agree on much, but they do agree on profitability. So I think it's reasonable to say that it had some impact. And so we felt like it's due time to look back at the literature, figure out what we've learned, and really the point is to try and connect a bunch of themes that seem disconnected, but that can really be brought together by thinking about profitability.
So we are going to dive into each one in a bit of depth, but can you just summarize what have we learned about profitability since its initial publication?
Yeah, sure. So in the paper, we could have looked at more things, but we specifically looked at 3 things. So we looked at quality investing in all its shapes and guises, and what we figured out is that profitability really does a striking job explaining quality investing. Whether it's the quality metrics that have been suggested by academics, the factors suggested by academics, or the ones that are typically applied in practice, profitability does a really good job explaining those. It also has really strong power pricing defensive equity strategies. And that is quite interesting because you wouldn't expect defensive to be particularly related to profitability a priori, but it does a really good job pricing defensive equity strategies across several different ways of constructing those. And then the final thing we look at in the paper is value investing, because one of the main points of Robert's 2013 paper was that profitability is the other side of value. And we've seen value have a pronounced period of underperformance in the US since 2007. And so we try and shed some light on that. How much can profitability explain and what's left off?
So let's go deeper on that, go deeper on quality. How well does profitability explain the returns of portfolios that are actually formed on quality?
Yeah, so in a nutshell, basically none of the quality metrics that we consider in the paper add anything in terms of being related to returns on top of profitability. And so this is, they don't agree on much. Many of these quality metrics, they come in many different shapes, and they target different aspects, and you tend to see a lot of composites being used in the literature, and it can sometimes be difficult to figure out exactly what the different strategies are doing. But irrespective of which one you look at, they really don't add anything on top of profitability. The converse is false, though. So profitability tends to add something in terms of returns, in terms of being related to returns on top of profitability. So on top of quality, sorry. So if you were a quality investor, there would be some information in adding profitability. If you're a profitability tilted investor, there's really not much evidence that adding quality will add anything.
Oh man, that's interesting. And that's true over a whole bunch of different metrics,
It
quality metrics.
is. Yes, it is. And some are, trying to capture aspects of the company that you would perhaps intuitively think of as related to profitability, and some not at all.
Yeah, that's really interesting. How in the paper, how do you quantify that explanatory power? Like when we say that profitability explains the returns of quality, but not the inverse, how is that quantified?
Yeah, so we go to the literature and we do what people typically do in the empirical asset pricing literature. So we start by looking at just average returns. So take your favorite quality metric, it can even be a composite, sort stocks on that metric, identify the ones with a high value for it, the ones with a low value for it, and then look at their average returns and take the spread. And then figure out, is there a statistically reliable and economically sizable spread? And somewhat surprisingly, the vast majority of the quality metrics that are popular out there, they don't actually produce a spread in returns. Some don't produce a spread at all, and some produce a little bit of a spread, but it's not statistically reliable. So already there's a bit of a question mark around the notion of quality. What they do produce is three-factor alphas. So when you look at the difference in return, so you construct the typical academic, long short quality factor, then what you see is that they do tend to produce alphas relative to the Fama-French three-factor model, and that's because most of them end up with a large cap growth tilt. So sort of the opposite of what the model would predict should have high average returns, and so you end up with large three-factor alphas. But then the three-factor model was extended exactly to include profitability, because profitability tends to capture variation in returns beyond what is captured by the market, the size factor, and the value factor. And once you adjust for profitability, you see that none of these quality metrics produce any kind of alpha. This is whether you include the other factors in the five-factor model or whether you do it just relative to profitability by itself. And so the academics, they call this spanning tests. You want to see if, a quality strategy is spanned by profitability, and profitability spans all the quality metrics we look at. The converse is not true. None of the quality metrics we look at span profitability.
Wow.
And how many different flavors of quality did you look at?
Yeah, so we did a fairly deep sort of dive into the literature. We also looked at what practitioners tend to use, and we ended up with a total of 15. So we have 12 metrics that are commonly used in the literature or by academics to try and capture sort of one particular notion of quality. So it's things like the earnings of the company, the earnings volatility of the company, the leverage. You can think of a composite of those three that ends up being called the Q score. There's lots of distress-related measures, so the Campbell et al. Distress measure, the O score, and then there are even things that are related to defensive characteristics in there. And so we also look at a composite of all of these 12, right? So that's 13 in total, and then we add two more, which are quality definitions that come from, let's call them alternative factor models. So there's the quality minus junk, QMJ, which is a fairly famous quality factor that's by Asnes-Ferzini and Peterson and is part of AQR's factor model. And then there is the quarterly return on equity, or ROE, that's due to Huzhu Zhang's Q factor model, which is sort of, one of the competing factor models out there in the literature. The last two are sort of interesting because of the complexity in the way that they're constructed and the difficulty of really interpreting what they do. So QMJ, for instance, is based on 28 different signals, right? And many of those 28 different signals are known to produce large three-factor alphas. So it's not really that surprising that by putting them all together, sort of in a composite, you get something that has a very large three-factor alpha. ROE, the quarterly version, is kind of in a similar way. It can be difficult to unpack exactly what it's doing.
Incredible. And then the simple version of just profitability is able to explain whatever those things are doing.
Yeah, and that's because we try and break down exactly what are these different quality notions and these different quality factors trying to do. And most of them do have loadings on the other factors. So as I said, they tend to be large cap growth. Some of them also have a little bit of a low investment loading, but really the factor that has the greatest explanatory power for all of the 15 that we consider is profitability. They all, to a certain extent, load on profitability. The one that loads the least is book leverage, which is one of the quality notions that have been suggested. But otherwise, they all load heavily on profitability. They tend to take positions in profitability. And so they're basically noisy versions of profitability, if you will.
Yeah, really interesting. What's the relationship between quality metrics and fundamental momentum?
Yes. So this is really something where it's the academic quality definitions that tend to have a position in earnings surprises, and so it's QMJ and the quarterly ROE. We show in the paper that they tend to have mechanical tilts on earnings surprises or the signal that underlies post-earnings announcement drift. So when you look at QMJ in the way that it's constructed, it depends positively on earnings growth, and it depends negatively on earnings volatility. So the way that the literature has typically measured earnings surprises is by taking, the year-over-year change in quarterly earnings and then divide that by the volatility of quarterly earnings to get what's called standardized unexpected earnings. And when that is high, then you say that there's a positive earnings surprise. When it's low, then you have a negative earnings surprise. When you form a factor on those, you get what's called post-earnings announcement drift, or fundamental momentum, as Robert called it in one of his earlier working papers. Now, because of the construction of QMJ, it tends to load quite heavily on post-earnings announcement drift. So it's not a pure sort of low-frequency profitability factor. It has a little bit of PED in it. Now, ROE, the quarterly ROE, that part of the Q factor model, is even more so a PED factor, because the way that it's constructed is that you don't take the return on equity from the annual statements, you take the return on equity from the latest quarterly earnings announcement, and that basically means that it's driven more by earnings surprises than by this low frequency type of profitability. It's this ROE, the quarterly version, is essentially just a dirty version of PED. And so because of this conflation, it can sometimes be a bit difficult to understand exactly what are these two factors trying to do. But they both have enough of a profitability exposure that you can still price them using just simple profitability.
And what are the implications for investors if profitability completely subsumes the whole idea of quality investing?
Yeah, so basically, I think what we end up arguing in the paper is profitability is by and large all you need. If you want to capture this dimension of expected returns, which we have a theoretical underpinning for, and there's lots of evidence for it in the US, in developed markets outside the US, in emerging markets, then profitability is all you need. Quality gives you a kind of diluted exposure to profitability, right? It's capturing some of the same things. It's not wrong in any way to do quality investing, but given that many investors think about making efficient use of their capital, you might as well trade profitability. And the one additional benefit of that is that it should lower your monitoring cost, right? All else equal, it is easier to monitor a portfolio that is based on one dimension of what quality is instead of a composite that's based on 3 or 28 different metrics. So there are some practical benefits as well of shifting the focus towards profitability instead of thinking of the broader notion of quality.
Really interesting. How do defensive, low volatility, low beta, that whole idea, how do those type of investment strategies look through the profitability lens?
Yeah, so defensive equity is interesting because it's both a separate asset class, right? Whether you look at the literature or you look in practice, but it's also often included as part of quality in investing. It's often considered a quality dimension. QMJ has a dedicated betting against beta tilt, for instance, right? So it's right in there as part of the 28 signals. But a priori, you wouldn't think that there is any connection between defensive equity characteristics and profitability. So defensive equity is typically measured by, as I said, beta or by low volatility, either total volatility or idiosyncratic volatility, doesn't really matter. But what we show in the paper is that profitability is strongly related to these defensive characteristics. Actually, high profitability is the most important predictor of low volatility. And controlling for profitability, valuations also become really important predictors of volatility. So by having profitability in there, you can sort of decompose exactly what are these defensive equity strategies trying to do. And so if you use the standard academic construction, just like the way we construct HML or the profitability factor, then you see that neither beta nor volatility produce a significant spread in returns, just like the other quality notions. They do produce large 3-factor alphas, again, because they tend to load on large growth, but, it's mostly driven by the short side. It's mostly driven by these high-risk stocks. It's really not a low-risk anomaly, which it's also been called. It's really a high-risk anomaly, and it's because those high beta, high volatility stocks, they tend to look like small cap growth, low profitability companies. And so when you don't have a profitability factor in your model, you're not capturing that. And so you end up with the model not being able to explain the return. Once you have a profitability factor in there, you see that the alpha goes away. There's also a bit of a link to the investment factor, kind of, the 5th factor in the 5-factor model, but it is sort of a slightly second order importance compared to profitability. If you start relaxing some of the sort of the standard construction methodologies that we've now been using since Fama and French 1993, then you can get slightly different results, and some papers in the literature have that. But we try and stick fairly closely to the standard academic construction.
Okay, so you mentioned the importance of the short side there. One comment that we've heard on low volatility is that things change when we move from that sort of academic long-short setting to a practical long-only setting. So I'm building a fund, and it's a long-only fund, an ETF or whatever, and I'm going to just buy stocks. I'm not shorting anything. What does profitability say about long-only low beta specifically?
Yeah, I've heard about this, and there's a string of papers that are arguing for sort of long-only defensive equity strategies. The thing is, we show in the paper in a couple of different ways, both in the U.S. and developed markets outside the U.S. and in emerging markets, that standard long-only low beta and low volatility portfolios, they have 0 5-factor alphas. They don't produce 5-factor alphas. And so the papers that are claiming otherwise, they typically deviate from just the standard methodology of forming portfolios. Even long-only portfolios, they typically deviate by applying leverage or assuming that you're hedging out some kind of market exposure. And so that tends to change the playing field of a little bit, and it makes it difficult to evaluate. If we're going to change the way we construct these things, then, should you also change the factor model that you're using to evaluate them? And so you end up sort of, down a rabbit hole. We try and stick fairly closely to the common standards. But what we can see is that your standard long-only defensive equity portfolio looks like a simple portfolio constructed from high profitability stocks with low investment. So high profitability, low investment, it's those two new factors in the 5-factor model that are really closely related to what the long-only defensive equity portfolios look like. And so in the paper, in one of the appendices, we do a very simple experiment. We take an 80-20 portfolio. In the 80 part, you have high profitability, low investment stocks. Okay, just long on. And in the 20 part, you put the rest of your money in T-bills. So you're not even 100% exposed to equities at this point. we show that that portfolio, it outperforms long-only defensive equity strategies, whether they're formed on beta or on volatility. And we also show that long-only defensive equity strategies don't have an alpha relative to that simple 80-20 combination. So again, you want to make efficient use of your capital, right? I can explain why high profitability and low investment is related to returns. I don't need to estimate either of those things because I can observe them directly from income statements and balance sheets. It's fairly easy, and I'm not even 100% exposed to equities, right? I'm really trying to get that diversification that I get also from bonds, and that performs, if anything, better than long-only defensive equity.
That is super
Wow.
interesting. So you're lowering your beta/volatility directly by reducing your exposure to stocks and then applying the same kind of factor tilts, and you're getting to a similar place, but it's actually performing better than a portfolio formed on volatility or beta.
Yeah, I mean, sometimes simplicity is just, very nice.
Absolutely. So there's been a ton of alternative value metrics proposed to replace the apparently archaic price to book. So how do these alternative value metrics hold up when you actually consider profitability?
Yeah, my boy price to book has taken a lot of beatings lately, but I mean, just like quality, there are really many different ways of measuring value. But the difference is we tend to agree more on how to measure value and get compared to quality, right? Because when you think about valuation, it's all just a scaled version of price, right? It's all just a way to scale prices. And the idea is you want to figure out what do you scale prices by so that they're comparable in the cross-section and over time, right? And so because of the proliferation of these alternative value metrics, we look at quite a few of them that have been proposed in the literature. So there are some really popular recent ones like EBITDA to enterprise value. And then there's, various versions of adjusted book to market where you adjust for intangibles, you adjust for internally developed, an estimate of the value of internally developed intangibles, you adjust for goodwill, things like that. So we ended up looking at 13 of them, and just like in the quality section of the paper, we also find that none of them produce any alpha relative to standard value and profitability, right? So even though they have been sort of promoted as in they produce a better value metric or they produce a better value premium, they don't actually add anything on top of standard value and profitability. The reason is something that the academics in a sort of a wonky way call a factor rotation problem. And it sounds sort of, super fancy, but what it actually is that your improved performance on top of the standard factor is not because you found a better signal. It's because you have sort of blended the traditional signal with other factor exposures. And it's through that rotation that you then get the better performance. In this case, all the improvement comes from rotating out of standard value and towards profitability, right? And so to really hammer that home, the case in point is that we look at a mechanical rotation in the paper. So we look at profits to price. That is literally profits to book times book to market, right? So it's a mechanical rotation of the two. It is the alternative value metric that generates the largest spread in average returns of all the 13 that we consider, just the mechanical rotation. It's also the one that produces the largest three-factor alpha of all the 13 that we consider. So it just looks, amazing. Relative to the five-factor model, has no alpha whatsoever. So again, if the point is to try and improve on value, the adjustments that we look at there don't really seem like they're doing anything else but just tilting on profitability.
Yeah, that makes sense. So it's like you're really just adding profitability exposure. The other value metrics aren't better value metrics; they're just combining profitability with value.
Which is great. I mean, combining profitability with value is great. And Robert argued for that in 2013. We argue for that in the paper as well. But again, make efficient use of your capital. And there are lots of positives to price to book. It is persistent. It is nice in implementation. It leads to the lowest turnover. It cleanly separates the valuation channel from the profitability channel. And again, no evidence that any of the other metrics, including the ones that adjust for intangibles, are adding anything on top of it.
Yeah, it's so interesting because like pre-profitability, these value metrics maybe they were better than price to book
Yeah.
because they were giving you profitability exposure. But now that we know about profitability, like you said, there's a more straightforward way to get there.
Yeah, and again, it's not wrong, right? Lots of index funds, quant managers, they use typically a composite of value metrics, and their argument is, well, we don't know which signal is going to work best, so we're going to diversify across signals. Sure, it's not wrong, but there is a more efficient way to allocate your capital. There is a way to go directly to the source.
Right. Well, once you know about profitability, that is true.
Exactly.
Prior to that, maybe we didn't know, so maybe it did make sense to diversify.
Definitely.
You mentioned value's recent underperformance, particularly in the U.S. earlier. How much of that is explained by profitability?
Yeah. So the underperformance that we've seen for value is very much, a U.S.-centric phenomenon. It has not been to the same extent negative in developed markets outside the U.S., and it's even been positive in emerging markets over the same period. But in the U.S., you saw an underperformance for value since its latest peak, which was in 2007. And so we argue that around half of that negative performance, around half of that underperformance can be explained by profitability, or at least can be linked to profitability. We're not sort of arguing for a causation here, right? This is all empirical asset pricing is almost always about correlations, right? The thing is that what you had was that it was a period of strong underperformance for the standard value factor, but it was coupled with a period of strong outperformance for the profitability factor during that same period of time, and they were strongly negatively correlated. So what we argue is that by just accounting for the negative correlation that standard value had to profitability, it accounts for a headwind of about half of that underperformance that you see over that sample. The remainder, so the remaining half of the underperformance, we provide some evidence that it has something to do with industry tilts. The standard value factor tends to take some quite a bit of industry tilts beyond sort of being short profitability. It's also betting on some industries. And so we show in the paper that if you construct a standard value strategy, but you put in some sensible controls for that short profitability exposure, and also you try and rein in a bit its industry tilts, then you actually get something that looks a lot more reasonable. It has lower volatility. And it actually ends up having a small but positive average return since 2007. It's not significant, but it is small and positive, which is a long way to go from the very negative one that you see for just unadjusted value.
So if you go and build a standard academic value portfolio, it's going to be tilted away from profitability. It's going to have some big industry tilts. And if you go and adjust for those things or take those things away, take the negative profitability tilt away by adding profitability exposure to the value portfolio and constraining the industries, then all of a sudden that negative gap over that period shrinks, is what I'm hearing.
Yeah. Yes. So the negative profitability exposure, we understand why, right? Value stocks, they tend to be small and unprofitable. Growth stocks, they tend to be large and highly profitable. So there's kind of a mechanical shorting of profitability in just a pure sort of academic value strategy like that. But when you also look at it, you tend to see that certain industries show up disproportionately often on the value side and on the growth side of a standard value strategy, right? So on in the value side, you tend to have things like energy and financials. On the growth side, you tend to have, tech and healthcare and things like that. And what we show in the paper is that those industry tilts have driven more of values volatility than it has driven its average returns, right? So it accounts for a big portion of the volatility of the value premium, but over the long sample, it's actually been flat in terms of adding anything to its return. So if you manage those industry bets a bit in the construction of your value strategy, you tend to get something that is less volatile and also performs better, especially when you also control for profitability. That's sort of, it's of course, there isn't a one-to-one mapping between what you do in the sort of academic factor space and what you do in practice, but that's generally speaking what we try and do in Dimensional with our value strategies. We also consider profitability when we construct value strategies, and we also manage the industry and sector tilts so they don't sort of run haywire and end up driving a lot of uncompensated risk, if you will.
Right. Yeah, that makes sense. Can you mentioned, I think you mentioned earlier that profitability has sort of a strong theoretical story. Can you talk about at a sort of fundamental theoretical level what makes the combination of traditional value like price book and profitability a sensible combination for explaining differences in returns?
Yeah. So to me, it really, the fundamental story really starts with this basic rule that we have in asset pricing, that price is equal expected discounted cash flows, right? The price of any investment today has to be my expectation of what I will get out of it in terms of cash flows, and then I discount it back to present value using, some discount factor, some notion of the cost of capital, if you will, that reflects the riskiness that reflects my expected return. And so if I observe a low price, then that can mean two things. It can mean that the discount factor is high, which is sort of what I want. That's a high expected return. But it could also mean that the expected cash flows are low, right? So prices can be low because of low expected cash flows or because of high discount rates. I'm mostly interested in the latter. And so by controlling for profitability, what you end up with is making the price signal more informative, because now if I compare two stocks that have the same profitability, that's my proxy for the expected cash flow channel. And then I know that the one with the lower price, that's because of the discount rate channel, right? So now I've made the price signal more informative. Coming to what we actually do in practice, the book to market and profitability work really well together, because book to market is sort of the cleanest pure valuation measure that you can get. It has very little to do with profitability, right? So book equity, yes, there is a mechanical link to past earnings and things like that, but very little in terms of the actual profitability channel. And so it becomes a very clean valuation metric. Profitability, on the other hand, because we avoid scaling it by price or something like that, it becomes a very clean expected cash flow channel. And so you have two measures that are, cleanly separating these two effects. And so they work really well. And beyond sort of, the academic jibber jabber, in practice, price to book and profitability work really well because they have hardly any overlap, right? Again, the price to book tends to go for these small companies that don't have a lot of profits. Operating profitability tends to go for large companies that have growth-like valuations, and so they sit on opposite sides of the market. So that means that, very little overlap, lots of diversification, lots of flexibility to try and blend them together in a sensible way. In practice, they also work really well.
Man, that makes a lot of sense. So it's like instead of taking one of the other value metrics that we talked about earlier that has some blend of value and profitability in one metric, these are like two very distinct ways to measure the two different things. And then you can blend them together however you want, but you can be precise about it because they're such distinct metrics.
Yeah, our portfolio managers here, they tend to talk about that they give them a lot of control, right? Because there's little overlap, and so they can clearly see why they're holding this particular stock. due to the valuation measure, and why they're holding this particular stock due to the profitability measure. And so that's really nice in constructing portfolios and managing them. So it matters in practice as well.
What are the main academic implications of the findings documented in this paper?
Yeah, so I think the paper for academics, first of all, it provides a unifying framework that connects a lot of seemingly unrelated things, right? So it connects a lot of these different quality notions to basically just profitability. It connects the low risk anomaly, the defensive equity, strategies. It connects it also to profitability. It cleans up a little bit in the in the factor zoo, and it provides a unifying framework for understanding many of these things. That's kind of empirically, but theoretically, it also has some implications, because it basically says that you really need to think about value and profitability together, even at a theoretical level, right? So lots of academics, they will write down theoretical models for why we should, for instance, see a value premium, right? This is one mechanism that will lead to a value premium. It could be related to, capital investments, or it could be related to macroeconomic risks, or some combination. But they're trying to explain why you should see a value premium and derive some testable predictions from that. I think our paper is pointing towards that that's no longer enough, right? A model has to be able to produce a positive value premium, yes, but it should probably also be able to produce a positive profitability premium. And really importantly, those two should be negatively correlated within the model. Right? If the model cannot produce those sort of empirical facts, then it's missing something. And then that means that whatever you're getting out of it might be incomplete.
Listening to this are many practitioners who I'm sure are wondering, what are the main insights for them?
Yeah. I would say that I think this shows that parsimony goes a long way, right? So you can be parsimonious about the way that you think about quality investing. You don't need a whole list of different quality metrics. Profitability really is the one that tends to be the strongest and tends to explain them all. And you don't need a separate consideration for defensive equity, really. That's what we talked about before. So again, it shrinks kind of what you need to think about. It brings it down to something more of a unifying framework. Many investors that I talk to, they're constrained in, let's say, how much tracking error they can take, or how much active share they're willing to take in their asset allocations, how much they can deviate from the market. And so they want to think about how to efficiently allocate, how to efficiently deviate from market weights. And you just don't get a lot more efficient than just by having a clean cash flow channel, which is profitability, and a clean valuation channel, which is price to book, I would say. I'm in a lot of conversations right now with investors who are, maybe looking at the size of the US and global markets and thinking, should I do something differently? If I am going to hold the US at market weight, and given those really high valuations at the top, and given that concentration that we're seeing, maybe I should go for quality, right? Maybe I should at least get some quality for those high valuations. Well, I think our paper sort of points towards, okay, first of all, how should you look at valuations, and how should you try and identify quality for that valuation? And so this is why I think profitability right now is very appealing, especially when you combine it with price to book.
We've been talking about profitability. You mentioned it once, I think, but we haven't talked much about how you actually measure profitability. Can you talk about what metric Dimensional uses to implement profitability in portfolios, and maybe also why that metric instead of some of the alternatives?
Yeah. So I've kind of purposefully not defined what I mean by profitability, and that's because it's surprisingly robust, right? You get by and large the same results depending on sort of irrespective of which profitability measure we use, but we do quite a bit of work to try and identify which one we should use. We've done that here at the firm, and we also continue to do that in the paper. So the one that we use in the firm and in the paper is operating profitability, which is you start with Robert's gross profitability from 2013, right? So revenues minus cost of goods sold. Then you subtract SG&A. and you also subtract interest expense, and you scale that by book equity. The reason why you have these two extra elements, SG&A and interest expense, is because it accounts, those two items, they account for differences in operating expenses across industries, and they also account for differences in leverage across industries. And those two things are important. It just makes the profitability measure comparable and easier to interpret. In the literature, and this is something we review in the paper, there's talk about sort of, one particular alternative to operating profitability, which is called cash profitability. And the idea is you take operating profitability, just like I was talking about it before, but then you subtract one additional item, which is accruals. And so accounting accruals are sort of it's an accounting tool to align the timing of expenses with their revenues, right? So you can book the expenses when the revenues come in, you can book the revenues when the expenses are incurred. And it basically means that your profitability metric becomes comparable across firms and over time, right? It's that. But when you subtract that out, you get down to the actual cash that the company has at hand, right? What are the actual cash flows that the company has? And so we compare those in the paper to try and figure out which one corresponds better to theory. We think that's probably the best way to differentiate between them. And theory basically calls for a profitability measure that predicts future cash flows. This is why we use current profitability, right? We're not interested in the past in terms of what the company has done. We're interested in what is it expected to deliver in terms of cash flows in the future. And so you should really think about the profitability measure that is the best predictor of future cash flows. Operating profitability, we show in the paper that it predicts its own future growth, right? So companies with high operating profitability today tend to grow faster in terms of operating profitability in the future, but it also predicts the growth in earnings. So they also tend to grow their earnings faster in the future, which we think is a really sort of, desirable property for a profitability measure. Cash-based operating profitability is a lot less persistent. So it actually exhibits mean reversion, in the sense that companies that look high on cash profitability today, they actually tend to grow negatively or sort of, stagnate in terms of their cash profitability going forward. And it doesn't predict the growth in earnings or anything like that. This is true in the US. It's true outside the US and developed and in emerging markets over the shorter samples as well. And we're talking about, earnings growth over long periods of time, 5 years, 7 years, things like that. So we think that's a pretty compelling argument for sticking with operating profitability.
Yeah, okay, super interesting. So not a huge difference, but theoretically you want something that's persistent, and operating tends to be better than cash-based for that purpose.
I would say so, yes. And also one thing that we've observed in the data is that the accruals effect has gotten weaker over time. And so that's the only difference between them, really. So the accruals have, generally speaking, the accruals effect is very much a US phenomenon, and it's gotten a lot weaker post-2000. There's no theoretical kind of argument for why it should get weaker, but that's kind of what we see in the data. And so the difference between them has also sort of, gone down in terms of their ability to predict returns, and the accruals effect doesn't really seem to be adding that much over the last 20, 25 years.
Okay, interesting. You mentioned earlier, you were just talking about the idea of people worrying about their U.S. equity allocations right now based on where valuations are and the size of the U.S. market and all that stuff. You got a paper that looks at that concept. Can you talk about the downsides of tilting toward or away from a country based on its aggregate characteristics, like in the U.S. example, tilting away from the U.S. because it looks expensive?
Yeah. So we a bit tongue in cheek, we called the paper "Few and Far Between." And that's both because when you start sorting sort of countries or industries on these, factor characteristics, they're few and far between, but also the benefits are few and far between. You don't actually get that much from it. So the premiums have historically not been driven by countries, right? They've been driven by stocks within countries. When you sort countries on something like their valuation or their size or their profitability, then you tend to see that the spreads kind of go in the right direction. They have the right signs, right? You expect to see something like a size premium, a value premium, a profitability premium, maybe even a momentum premium, but they tend to be quite weak, right? And they tend to produce, unreliable spreads in returns and no alphas relative to the factors when you construct them from individual stocks. So this is why we don't really see much of a benefit there. The intuition is that there is some informational loss, right? There's a lot of cross-sectional variation in these characteristics, and so by sort of aggregating up into these little components that are sort of countries, you lose a lot of that variation, and so you don't really get much of a benefit in terms of trying, over the long term at least, trying to sort of tilt away from countries or industries based on these characteristics. There might be other reasons to try for tilting away from certain countries. You might think about a home bias, right? So I live in Europe. I might want a home bias in my portfolio for other reasons, but it would not be driven by, let's say, that I'm expecting a premium for that because Europe is on average smaller or cheaper than the US.
I want to dive into industries a bit more. I know you mentioned it, but what about over or underweighting industries based on their aggregate characteristics?
Yeah, the story is relatively consistent. You tend to see that these industries don't really drive the premiums. Again, the spreads kind of go in the right direction, but they tend to be fairly weak. The only nuance to that is when you look at industry momentum. Right, so there's a famous JF paper by Moskowitz and Greenblatt from 1999 that looks at industry momentum and shows that it's actually strongest at the 1 month horizon, which is kind of interesting because for individual stocks at the 1 month horizon you tend to see reversals, right? And I've actually written a paper with Robert and some of my colleagues here at Dimensional on that. But at the industry level, you actually tend to see momentum. And that tends to be quite strong, and it is significant, and it does produce an alpha, but it just has 400 to 500% turnover per year. So it's very difficult to capture sort of in your standard practical portfolio. And so this is why we kind of reach somewhat the same conclusion with the footnote that industry momentum exists and tends to be quite strong in the US and outside.
So in the other than the industry momentum piece, in the previously mentioned results, when we're saying that tilting toward industries and countries doesn't have much of an effect, how important to that finding is it that the investor is tilting at the security level?
Yeah, so that is really kind of the nail in the coffin in terms of trying to pursue these premiums at the country level or at the industry level, because if you weren't aware of how these premiums behave at the individual stock level, you would again sort of be just looking at sorting entities on characteristics that should be related to expected returns, and then maybe that's the only thing you can do. But again, that ignores that we know that these factors work really well at the stock level. And so once you know that, once you look at whether you're adding anything by taking country bets and industry bets on top of having the security level exposures, then you see that these country bets and industry bets don't add anything. They don't have any alpha. They're spanned by the security level factors, if you sort of want to talk in the wonky academic way. One thing I really do want to mention also is that once you start aggregating individual stocks up into specific countries and industries, you have fewer building blocks to play around with. And so that means that it's quite difficult to take into account premium interactions, right? So imagine just doing a simple 2x2, 2 groups on price to book, 2 groups on profitability, right? Over that grid, you would want to emphasize the ones that have a low valuation but a high profitability, and you would want to underweight, de-emphasize the ones that have a high valuation and no profitability. Just a simple 2x2 grid can lead to very empty and under-diversified portfolios if you do that at the country level, and something very similar also happens at the industry level. So there are a lot of drawbacks to sort of going away from just doing things at the security level.
Interesting. So if you, for some reason, couldn't tilt at the individual security level, maybe there's something there trying to tilt at the country or industry level, but it's a lot noisier. You've probably got more idiosyncratic risk.
Yeah.
And because we can tilt at the individual security level, it's like there's really no point in trying to tilt at the country or industry level.
Yeah, completely agree. Yes.
So how does dimensional deal with country and industry weights?
Yeah. So, based on that research, but also a lot of other work that we've done, we generally tend to sort within countries, right? So we go within each country, and then we sort on the characteristics that we care about: size, relative price, profitability, and then we aggregate, sort of, up across countries, and we tend to generally hold countries at their market weight. Right? Because these sort of, these borders that we've drawn in the sand don't really tend to be something that differentiates high from low expected returns. So we tend to hold things at market weight. There's also that whole discussion around, are some of these big companies, are they truly sort of based in one country, or are they really multinationals,
Exactly.
or they're getting sort of, their revenues from many regions and so on. The thing about doing things at the individual sort of country level and then aggregating up is that you will naturally get some industry bets from that. So tilting towards value, as we talked about before, you tend to get sort of more exposure in energy and financials. Tilting towards profitability, you get more exposure in tech and healthcare, things like that. So you will naturally, in the pursuit of the premiums, get some industry bets. If you try and neutralize those completely, then it tends to hamper your ability to capture these premiums. Right? Because they want to go into a little bit of deviation at the sector level. And having a completely sector neutral portfolio often requires a lot of turnover, a lot of trading, which is, again, inefficient use of capital. On the other hand, letting them sort of, go without constraining the industry deviations at all will create some of that volatility and some of those concentrations that we talked about before. So we balance that trade-off by introducing sector caps, right? So we limit the amount that you can deviate from the market weight in that given sector when you are pursuing these premiums, right? And that can vary a bit from strategy to strategy, but we think that's a good way of sort of having enough flexibility to capture the premiums, but not sort of introducing concentration at the sector level.
Makes a lot of sense. All right, we have last few questions here on private markets. You've got a really interesting paper looking at that. Can you talk about how much of the global investable universe in stocks, bonds, and real estate consists of private funds?
Yes. So we wrote a paper last year where we call it Understanding Private Fund Performance, because that's basically what we tried to do. We were getting a lot of questions about private markets and about private funds, and we like to look at the data. And so we got some data on private market vintages going back to the I think the earliest start is in the 80s, and for VCs, and then buyouts, then private credit and private real estate somewhere in the mid 90s. We have about 6,000 funds in the sample, so it's a pretty sizable data set, and we try to understand different things that might be of interest to investors. But one thing that we did look at sort of as a snapshot at the end of the sample was, what's the size of the investable universe here? And there's a lot of discussion around that. And what we found is that about 10% of the total global investable universe is in alternative funds. So that includes private funds and hedge funds, right? You often hear a much larger number. You often hear that, private markets are much larger than public markets, right? But the thing is that not everything that is unlisted is investable, right? You cannot go and buy shares in every single private company. You can't take a stake in a private infrastructure or a private real estate project. And so we really have to think about, what's the AUM? What is actually investable today? Where can you go out and get some exposure to this in a fund? And there, it turns out that it's about 10% of the total investable universe. The remainder is about 45% in global equities and REITs, and 45% in global fixed income. And so that kind of sort of market breakdown, we think, is a pretty decent starting point. If you are actually going to venture out into private investing, think about those market weights when you're allocating.
Man, that's interesting. Because we definitely see institutions and other advisors with 25, 30% on alternatives.
Yeah.
For what reason? But we talked about market cap weights a minute ago. That makes sense. So if you wanted to say, well, hey, I'm going to build a market cap weighted exposure to private asset classes, it's going to be like 10%, not 30.
Something in that ballpark, yes. That's at least what it looked at. How it looked at the end of last year, I think, when we last updated those numbers, and it's been fairly stable. It hasn't moved around that much.
We've even seen some this week, Ben, where they're 100% in private assets because public markets aren't working anymore. It's incredible.
Interesting.
So how important is benchmark choice when analyzing the performance of private funds?
I would say that it's crucial, right? So based on the results in the paper, your choice of benchmark can completely change your conclusion. So we often see private funds being benchmarked to style neutral indices, sort of market wide indices. You can, for instance, think about U.S. buyout funds. Their favorite benchmark is the S&P 500, which granted has performed, exceptionally well over the recent past. But generally speaking, you don't tend to see that U.S. buyouts look like the S&P 500, right? They are not this broad kind of relatively style neutral type of investment. They tend to take style exposure. They tend to take certain sector deviations compared to the market, and those tend to not be constant from vintage to vintage. They tend to vary. And so I think you get an incomplete picture of opportunity cost if you just benchmark to something that is market wide. The same is true in VCs, in private credit, and in private real estate.
So when you benchmark against a style appropriate benchmark, how do private funds tend to perform?
Yeah. So this is where you need some specialized methods to be able to actually talk about relative performance in the private fund space. An internal rate of return, an IRR, is not just comparable to an annualized compound return. I know that you've had Ludovic Phalippou on the podcast. He's brilliant, and this is one of his pet peeves that he writes a lot about in his papers and in his book, right? Just all the issues with IRRs. But the main one sort of right now, at least for me, is that it's not comparable to sort of the annualized compound return of any index. And so you need some specialized methodology. The consensus in the literature is to look at something called the Kaplan-Schwarz public market equivalent. It's named after this really phenomenal paper in the JF by Steve Kaplan and Antoinette Schwarz from 2005, and it's a money multiple. It's a benchmark adjusted money multiple, right? And it has several interpretations. You can sort of think about it as in you finance your capital calls by selling shares in the index or benchmark, and you reinvest any distributions back into the benchmark, right? That's one way to form a money multiple of that. Then you get the KSPME. Another interpretation is that it is the present value of distributions and NAV relative to the present value of contributions, where the present value is calculated by using the benchmark's cumulative return as the discount rate. And that last interpretation is really important because it links it to valuation theory, and it means that the KSPME is a proper risk-adjusted performance measure, right? And it can also not be fooled by leverage. This is often one of the concerns with IRRs, is that if you use leverage to pay out early, then you can sort of, get a higher IRR early on. And because, future, long out into the future, the cash flows matter less and less for the IRR, you can basically have a high IRR by paying out early. So there are some ways to fool the IRR that's not possible with the KSPME. And so this is the measure that we think of and that we think that people should use. And so by using that, what you see is on average, buyouts and VCs, they look like they outperform the S&P 500. They have a KSPME above 1 on average, going over the long sample relative to the S&P 500. But when you calculate that same KSPME relative to a small cap value index, or even a small cap growth index that is tilted towards the highly profitable small cap growth ones, then you tend to see that they on average perform just about in line with that, right? So your choice of benchmark can really change your conclusion around relative performance. For private credit, you see that again, according to the KSPME, they on average outperform the Bloomberg US Credit Index, but they perform just about in line with the Bloomberg US High Yield Index, right? So on average, you've gotten the same return by being in US high yield bonds. Private real estate tends to actually underperform the sector portfolio of listed real estate companies. So this is not REITs, but listed real estate companies, real estate operating companies. And they tend to underperform REITs based on the KSPME. So again, you can get wildly different conclusions depending on the benchmark. What I want to stress here is that this is for the average fund, right? There's lots of dispersion around that. But for the average fund, you can basically get the same performance by going into the public market.
That's a pretty wild finding, right?
Yeah, we find it quite striking as well. Yeah.
I mean, we've had people like Ludo that you mentioned on the podcast, so it's not that surprising, I guess, because we've seen research like this before. But you guys looked at more asset classes, more data, I think, than a lot of other papers have looked at, and yeah, that's pretty wild.
Yeah, we're quite happy with that paper, and it's still, I mean, it's about a year old, if not a little bit more, and we're still presenting it at conferences and for a lot of institutional investors. Yeah, it's been really useful, sort of digging into the private markets, even though we don't, as a firm, invest in that.
Right.
So fascinating. So, what do private assets look like through the lens of public market factor exposures?
Yeah, I mean, this is kind of a natural analysis to do, right? Whenever you talk to anybody sort of that likes to play with systematic factors or asset pricing models, then you want to figure out what's the exposure, right? So when you look at private funds and you look at their periodic returns, often you can only get them quarterly, right? And so the quarterly private fund returns, they tend to be a function of the NAV, of the NAV, right? And the NAV is an accounting appraisal of the ongoing investments, the ones that haven't actually been exited yet. And so because it's based on an accounting appraisal, they tend to not change that much, and they tend to not change that often. And so what that leads to is, lagging and famously smoothing, right? So periodic private fund returns, they have an element of lagging and smoothing. And so that means that you need to adjust for that whenever you're measuring factor exposures, because they can screw up your factor regressions. They can screw up your factor exposures. By the way, this is no different from when people started looking at real estate returns back in the 1970s. We have methodology to do that. It's really not rocket science. But it's important to do that. And another caveat, an important fact to mention, is that we saw a structural shift in 2007 because there was a change in the accounting rules, and in particular, there was the adoption of fair value accounting. This happened in Europe, and it also happened in the US. And fair value accounting basically means that you as a private fund manager cannot get your books audited unless you can show that there's some mark-to-market accounting, right? You have to show somehow that you're marking your current investments to deals that have already happened, or comparable investments from the public market. There needs to be something like that. And so, you asked me about what do the factor exposures of these private funds look like? Well, pre-2007, pre-fair value accounting, you mostly have negligible factor exposures, even when you adjust for lagging and smoothing, right? There's very little explained variation. After the adoption of fair value accounting, you see that the factor exposures of these private funds in aggregate can explain up to 70 or 80% of the variation.
Wow.
So it's really a material sort of, shift that we saw after the introduction of fair value accounting. And so if you look at the different asset classes, buyouts in aggregate, they mostly look like highly profitable companies, perhaps in the mid-cap space, something like that, which is kind of intuitive. That they tend to go for sort of your cash cow type of investment, and in aggregate they tend to look like that, and that explains north of 70% of the variation in quarterly buyout returns. VCs in aggregate, they tend to look like small cap growth but high profitability, right? So not these sort of the short end of the defensive equity strategies. They sort of they tend to be small growth but high profitability. Private credit tends to look like high yield, and they tend to not take material term exposure. So they're not really sort of differing that much on whether they take long duration, short duration. They tend to look fairly market-like in their duration, but have high yield. And private real estate, it does correlate with REITs, and it also does correlate in aggregate with the public equity market, but not very much. Private real estate is the asset class that we have a hardest time explaining by public market factors. It's the one that looks the most different, I would say, from the public market factors. Perhaps this is why it is somewhat popular as sort of, the quote unquote diversifier.
Interesting. Do you have any idea why that is?
I just think the composition of what you have in private real estate funds is quite different from REITs, in the sense that a lot of private real estate funds, they will sort of, get these real estate investments and just basically get the capital from them by renting them out. Let's say it's slightly different from what you see in real estate investment trusts. And so that basically means that while you have some connection because they're part of the same economy and they're largely speaking investing in real estate, it's very different assets that they're actually holding.
Interesting. Okay. So we've been talking about average fund returns, which has been super interesting. So we've got PMEs pretty close to style appropriate public market benchmarks, which is super interesting, but does make sense. And then we have factor exposures, the public market factor exposures that largely explain returns, aggregate returns.
Yeah.
Post 2007, once we have fair value accounting.
Yeah.
But again, those are average funds. In public markets, there's not huge dispersion between like the worst and best cohorts of mutual funds, for example. Can you talk about how much dispersion there is in private market fund performance?
Yeah, and I think there's a little bit of a wrinkle to what you just said around public sort of funds. So but let me get to that in the end. But what we see in the paper for private funds is that there is actually quite a lot of dispersion, right? So for instance, the top 5% in any of the four asset classes that we consider, they often double or triple your invested capital after management fees and carry. Right, so the top 5% of funds there, they really have quite impressive returns. The bottom 5%, on the other hand, they tend to lose half of your money after fees, maybe even more than that. Right, so quite a lot of dispersion between the top performers and the bottom performers. And we see that in all the asset classes. It is sort of the dispersion is widest in VCs and it's lowest in private credit, which is kind of what you would expect, right? That's sort of quite intuitive. It's quite difficult to compare that to what you see in public markets because of survivorship bias. So in public markets, the funds that live for a considerable period of time tend to be the ones that haven't closed down. That's kind of a tautology, but funds close down because of bad performance, because of outflows. The funds that do badly, they tend to not survive over long periods of time. I think over the past 20 years, when you look at U.S. equity funds, so U.S. domiciled equity funds, the survival rate, I think, is only like 45%, and the outperformance rate is close to 15% or something like that, right? So that survivorship bias means that it's difficult to compare that dispersion, because private funds, they tend to be 5, 7, 10, maybe even longer now year investments. But if you look at the dispersion that you see in returns over relatively short periods of time, where you have less of that survivorship issue in public markets, you tend to see as much dispersion in the private space as you do in the public space.
That is a really interesting point. So there's a chart that I've seen that shows the sort of increasing dispersion when you go from public to private markets, and I always just took that as, yeah, that makes sense. So I always accepted that as true. But what you just said also makes a ton of sense, that when you account for survivorship bias, you can actually have a lot more dispersion than it would look like if you just look at the sample of existing funds. And so you're saying that there's as much dispersion in public market fund performance as there is in private market fund performance.
When you look at active public funds, yes, I would say so. That would be my expectation. There is quite a bit of dispersion. Also, we recently were asked to do an analysis where we would look at exactly the dispersion in information ratios, right? So sort of outperformance relative to tracking error for active funds, and quite a bit of dispersion just over the last 5 and 10 years. So I think it's a pretty common phenomenon that when you think about active management, traditional active management, which private funds are just in the illiquid space, you tend to see a lot of dispersion between top and bottom performing managers.
Very interesting.
Yes, and the obvious next question, Mamdouh, given this wide dispersion, what are the criteria to predict these successful managers?
Yeah, that's manager selection is always difficult, right? The thing is that what people tend to think about is persistence, right? So they tend to think about, okay, I'm gonna go for the GPs that had a stellar vintage, because I expect them to have a stellar vintage next time as well. The thing is that there isn't a lot of evidence of persistence in the literature. Right now, lots of caveats around data here. I think the most complete data source that academics use is the data that was formerly sort of managed by a company called Burgess, and now it's been acquired by MSCI. That's the data that we use as well. And using that data set, there really isn't a lot of evidence of dispersion. And I'm particularly thinking of a particular paper from 2023 by Harris, Jenkinson, Kaplan, and Stuckey. It's called "Has Persistence Persisted?" And they basically find that there's no evidence of persistence in buyouts. There's a little bit of evidence of persistence in VCs, but that's kind of pre-2000. Afterwards, you don't see a lot of. We couldn't study persistence ourselves in this paper because of data issues. We don't actually have access to the individual funds or the GPs, right? We only have access to vintage level data, and so we couldn't study it. But using the same data set and using, fairly rigorous methodology, very rigorous actually, I would say that there isn't much evidence of that. So given that you don't have persistence, and given that there's wide dispersion, just like we talked about, you're basically back to due diligence, right? That should be the main criteria for selecting managers. And so I co-authored this paper with Wei Dai, who we also had on the podcast, called "Systematically Evaluating Systematic Managers," where we came up with this framework for what criteria should you look at before you hire a manager, and what criteria should you look at after hiring a manager. And these things extend beyond just systematic managers. For any kind of manager, really, before hiring them, you should look at their full investment proposition, right? So what kind of research do they do? How do they construct their portfolios? What is the process of going from idea generation to actual implementation? And then when you look at the full, when you look at the track record, don't only focus on the track record maybe of the funds you're interested in or the style you're interested in. Look at their full track record. Look at their survival in particular, right? Look at what is the percentage of funds they have that have outperformed their benchmark. Because if you pick that one fund that works well and the other ones don't, then that's not really sort of giving you a good indication for it being sustainable. And then, after you hire them, it's of course the continuous monitoring. You have to keep assessing, are they doing what they should be doing? Are they sticking to the investment proposition? Or are things in line with expectations? That holds in public markets just as much as it does in private markets. But in private markets, of course, you have, additional things like the illiquidity, and they don't report as often and things like that.
Man. And then you have to keep revisiting it. I do some volunteering on an investment committee, and investment committee meetings are always about, 3-year performance. And if things aren't going well, then you're reevaluating the manager. And I think that's pretty typical, but that all sounds,
it's tough. When you understand how much volatility there is in returns, and how likely you are to see negative premiums over a 3-year period, you really, it really puts things in perspective. I always like to highlight Fama and French's volatility lessons paper from the FAJ from a few years back. That's a good read for anybody thinking that 3 years is enough to evaluate any kind of performance. It can be tough, and I understand manager selection is difficult, but you really have to put things in perspective. And just one last thing around manager selection in private markets. It's always difficult to do manager selection, but the illiquidity and the way that private markets are set up actually exacerbates the manager selection problems, because you can't hold the market. You can't make your asset allocation sort of relatively manager agnostic. You can always do that in public markets, right? You can always go for something more systematic, something less dependent on which manager you choose. That's not possible in private markets. You have to pick a GP or some GPs, and so your opportunity cost can be a lot high.
Yeah, interesting. Which makes going into private markets in the first place a big decision, because you're forced to make that second decision about which manager to pick, which is a very difficult decision to make.
Yeah, absolutely.
How has private fund performance relative to public benchmarks, to appropriate public benchmarks, like we talked about earlier, how has that trended over time?
It's a good question. Again, because these vintages, they tend to last for, anywhere between 5, or you've even seen like 12-year vintages. Sometimes it can be difficult to sort of, discern a time trend. I don't think that there is a significant time trend that it's been trending sort of up or down. But what we have seen very clearly is higher correlations with public markets, right? Especially after 2007. There's just a lot more alignment in terms of the returns that you get in aggregate from private funds and the returns that you get from the public market. And I think that's important to take into account when you're thinking about an allocation going forward.
I love this next question. It comes up all the time. How much of the apparent diversification benefits of private assets is just an artifact of illiquid asset return smoothing?
Yeah. So I would say, based on what we can see around that structural break in 2007, pre-2007, a lot of the diversification, looked like it was overstated, right? It was because of the lack of fair value accounting across sort of a wide spectrum of these funds that the lagging and the smoothing really looked like, these private asset classes are, not entirely uncorrelated, but almost close to that, when you compared them to public markets. This was pre-2007. After 2007, and especially when you account for lagging and smoothing, we see these really substantially higher correlations, and it allows us to, I think, more reliably quantify the diversification benefits. Yes, the sample shrinks, and you also have the financial crisis as part of that sample, which tends to sort of, induce correlations by itself. We do some robustness in the paper where we throw out the financial crisis and get similar results. but we can kind of quantify it. And so this is where, you know, we find that, for instance, for buyouts, you can explain up to 80% of their returns just by their factor exposures. But what's important here is that we can't explain 100% of that, right? And we do some statistical testing to see if that explained variation sort of includes 100% as part of the set of values that you can trust in. And we, in most cases, we actually reject that you can explain 100%. And so that means that there are some diversification benefits. They're probably just not as high as you may have heard by looking at some of the marketing material, and especially if you look at sort of, you know, old vintages and old funds. The reason why I think we won't be able to fully explain the returns that come here, even after fair value accounting and even after controlling for lagging and smoothing, is that private assets at a conceptual level, they should expand the opportunity set that you have as a public investor, because you're adding things that are not available in the public market. They might be highly correlated with what you see in the public market, but they're actually not there. So sort of, you know, in a conceptual framework, if you think about the total market, which includes every single asset, you are actually getting slightly closer to that, right? But again, there are lots of caveats around that, and I don't want to overstate the diversification benefits given the high correlations we see in aggregate.
Yeah, it makes sense. So I think when we had Ludovic Philippou on, he if I remember the example correctly, he said like tech in Europe. If you really want to get a European tech exposure, you kind of have to go into private markets.
Yeah.
Maybe that may not be exactly the example, but conceptually, so that does make sense. If you're adding sector exposures that you can't really get in public markets, then yeah, you would expect some diversification benefit.
Yeah, and lots of institutional investors make that exact argument, right? That some exposures that they're looking for, they, you know, they believe, looking at the data, looking at what's available, that they can better get it through unlisted assets. And they might have an easier time accessing that than your typical retail investor or your advisor.
Yeah, it's getting easier for retail investors, which may not be a good thing. And actually, on that point, what effect do you think the increasing popularity of private investments and maybe also the increasing access to retail investors might have on their expected returns?
Yeah, this is, you know, one of the questions that I get asked, and it's tough, but I can say this: when you bid up the price of anything, then all else equal, you should expect its returns to go down, right? And so we've seen the democratization, if you want to call it that, of private investing. We've seen greater demand for private funds, whether it's in kind of, you know, retirement sort of solutions, whether it's in institutional portfolios, whether it's in even, you know, retail portfolios sometimes. And so that's removed some of the exclusivity that we see around private investment. And it's also, you know, put some pressures on GPs to deliver despite their much higher AUM, right? And so we've kind of seen indications, at least in the financial press recently, of vintages prolonging their lifetimes, exits being difficult to come by. We've seen continuation funds where, you know, an unlisted asset gets passed on to the next vintage and maybe even the next vintage again. So there are some indications here that, you know, the asset class is trying to cope with this increased demand. Ultimately, I'm a data guy. I don't sort of forecast, but I would say just take that into account, right? That you're not getting the same level of exclusivity that you tended to get before in private markets. There's a lot more demand. There's many more assets under management. So just be careful with that. And again, think about the market weight of that in your overall portfolio if you're going to allocate.
Yeah, I like that point. Okay, so you did this paper. You obviously spent a lot of time crunching the pretty cool sounding data set that you had. Sounds like you get a lot of questions about private markets too. What would you say are the implications of your findings for someone considering an allocation to private assets?
Yeah. So I I try to stay away from being prescriptive on asset allocation, right? Because I think that depends on so many variables, your risk tolerance, your horizon, what you actually want to achieve from this portfolio, and what else you're holding. But the findings indicate that, you should really have this middle of the road view of private assets, right? They're neither a fantastic unicorn, but they're also not just it's not just complete bogus. All of it. There are some positives and some negatives. The negatives, I mean, we talked about the wide dispersion that you see in performance between the top and the bottom, and because you have to allocate to managers, you are exposed to that dispersion. It's difficult to get away from that. It's difficult to make your allocation manager agnostic. Even sort of secondary funds and so on will only be able to capture that many GPs and that many individual funds. And there's also another negative, which is on average you don't actually see a premium relative to some of these styles, right? The average fund performs in line with some of these styles that we know from public markets. The positives is that there is some benefit of diversification benefits. I can't really sort of, there's some evidence of diversification benefits. I can't get away from that. But there are lots of caveats around, the types of fees that you're paying, and then the GP that you select. The GP that you select might just be very highly correlated with public markets, and you don't know that ex ante. So I would say if you're willing to stomach those caveats that I just mentioned, then, and you want to expand your opportunity set, fine. And you're willing to stomach the fees and the liquidity, and you might not have the liquidity exactly when you need it and all these things, then fine. But I would say start with the market weight and be very clear about your expected liquidity demands and what your tolerance is for some of these investments, maybe, continuing beyond what you expect, because we are seeing longer and longer vintages right now in private funds.
I think there's a huge idiosyncratic risk component too, right? With the manager selection, unless you have a huge amount of capital, like you're not going to get private equity or private credit or whatever. You're going to get a GP.
Yes,
and
that's it. And
that's a tough one.
And there is talk in the literature as well, around basically to get diversification in the private space, you need two types of diversification. You need diversification within vintages. So this is across managers, and that can be very difficult to get, especially as a retail investor or as an advisor, because they often have minimum capital requirements to be able to be part of a fund. And so spreading that out across many different GPs can be difficult. But you also need diversification across vintages, because one vintage might just be a bad apple, right? And so if you need that, then you need to keep allocating year after year to vintage after vintage in order and to multiple managers. And so you very quickly run out of capital.
Man. Or you do a continuation fund, which might have its own set of issues.
There are, again, idiosyncratic issues with continuation funds as well. You don't really get away from some of the liquidity constraints and some of the redemption limits and things like that.
And you might get adverse selection. I don't know, maybe. Mm-hmm. Or with the evergreen funds, I mean, the perpetual funds.
Yeah. There again, this is sort of the lack of exclusivity, is that what is being offered right now to retail investors. Again, not to say that I know exactly what's going to happen or I've looked at the individual managers, but these are all things that you need to take into account. Manager selection is difficult, irrespective of where you go.
Yeah, no, very, very interesting. Very cool look at the data. And like I said earlier, it was interesting how you guys looked at all the different private asset classes, not just one, which a lot of papers have done. But then taking the factor lens to private assets, super, super interesting.
Yeah. This has been an incredible conversation, Mamdouh. We have one more question for you. How do you define success in your life?
Well, yeah, wow. Venturing into philosophy now. So, I mean, I don't want to sound too cringe, but it's probably something like, doing something I love professionally, but at the same time being able to provide for myself and my family. I think, that marrying those two things together is probably some definition of success for me. I love doing research, right? And I did it as an academic before coming to Dimensional, and now I feel really privileged being able to do it at a firm that sort of appreciates that level of rigor and sort of, you know, the deep dives into the data and the theory. And it's, you know, compared to academia, it's great to be able to see some impact in the real world. I think, you know, one more aspect of success for me is to try and stay grounded and try and maintain some humility. I think in asset management in particular, there is a little bit of a tendency for successful people to sort of, you know, exhibit some forms of overconfidence or sort of say, oh, it's kind of my way or the highway. It's if you don't agree with what I'm saying right now, then we have nothing to talk about. And I think that's not really useful. I try to stay humble. I try and sort of, you know, keep an open mind, whether it's about, you know, wonky asset pricing research or it's more general. And I think that helps, you know, when you're out actually talking to real people about their investment decisions. So staying humble would also be part of success for me, I think.
Great answer. Not cringe at all.
Thank you. I appreciate that.
Great answer and great interview. Thanks so much for joining us, Mamdouh.
Pleasure. Thank you very much for having me.
Thanks, Mamdouh.